This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Welcome back to your TF Metals Report podcast highlights for the week of Monday, September 19th, 2022. A very volatile week that brought the September FOMC meeting, and that changed just about everything in the middle of the week. Beginning of the week, we were holding in there. Latter part of the week, not so much. Back on Monday in our daily podcast, we were talking again about Crash Watch and our worry that because of the move in bond market in nominal rates and real rates, that a lot of risk assets were hanging by a thread. Gold, stock market, just about everything is on Crash Watch. One of the charts we looked at on Monday was a comparison over the last 20 years of the TIP ETF as a measure of real interest rates with gold. And as you can see, they're very closely correlated. That's something we discussed on Monday, September 19. So when you plot that with gold, you can see why this is so disturbing. Because remember, the TIP is kind of a basic measuring stick of real interest rates. Rising TIP, falling real interest rates. Falling TIP, rising real interest rates. And what is the key driver of COMEX digital gold prices? Real interest rates. And you can see what I mean by that. But this goes back to 2003. The TIP began in 2004. The candlesticks are COMEX gold. The blue line is the TIP. And from 2006 on? I mean, you could be hard-pressed to find a tighter correlation between two different things than the blue line and the candlesticks here, right? Yeah, and look at what the blue line has done this year. Now, look, I don't think gold's going to 1,200, okay? But if the TIP keeps falling, at some point, gold's going to fall too. It may not take stonks directly with it, because, of course, stonks have been rallying since 2008 or 9 on just the simple $8 trillion expansion of the Fed balance sheet. But I'm not sure that's a whole, this isn't the TF stonk report. This is the TF metals report. This chart alone should give you pause, right? Should make you go, huh? I mean, I know we all know about the fraud of the digital derivative pricing scheme and everything else that goes with it. But price that is used to drive spot price at which the miners sell their metal is determined through the trading of the derivatives, and you can certainly see the correlation between the derivatives and the TIP. In that chart, again, that's the thing that kind of keeps me awake at night, staring at the ceiling. We don't just discuss precious metals at TF Metals Report. We talk about nearly everything, because you got to track everything if you're going to follow gold. But we don't just do precious metals and base metals. We've been on the uranium story for about a year now. Ups and downs, but very positive long-term fundamentals. So on Tuesday the 20th, we thought we'd talk about something fun. The way uranium has been performing this year and how it's been picking up as of late. We've been talking about uranium here for at least a year. I know I've talked to Rick Rule a couple of times, and he's all excited, as you know. But it's volatile. And uranium prices go up, and then they can't hold, and then they go, anyway, you get the idea. Well, this is the URA. I own this ETF. Not much. I don't know, 200-300 shares. Not much. But I own it. I figured it was a great diversified way to have some uranium exposure. A broad exposure on top of, what do I own? UEC and UROY. That are more specific plays. All right, so what do we see here from a technical standpoint? Well, there's a little bit of a head and shoulder bottom, right? The shoulder's at 19, the head at 18. It's also back above its 50-day, got above it in July, tested it for support in August, and now it's right on it again now. What do we want to watch for next? Well, on the upside, we want to rally, and we want to get above 24 because we haven't been able to sustain above 24 since April. And if you can do that, then you got a shot at breaking that downtrend line that goes all the way back to last November, which is now almost a year ago. Now, if it breaks down below its 50 and doesn't reverse, though, like it did a month ago, well, then what? Are we going back down to 19 again? Yuck. But this is interesting. And if you're looking to play uranium, then you're going to want to watch to see if it does break out, if it can move toward 24 and 25. Now, again, that's more than 10% from here. And if you just want to gamble, then you just bet on that actually happening. But it might be more prudent, given the moves that are coming, if it does break out, to kind of chill and wait to see what happens next. Wednesday, the 21st, brought the latest FOMC meeting, where the Fed reiterated that they want to kill everybody and everything by hiking rates nonchalantly, blindly into the future. They'll let the dust settle and see what kind of damage they do by the time they get done hiking, promising at least another 125 basis points in Fed funds by the end of the year. What's ridiculous is that anybody believes them, or that they believe their own forecasts, which are almost always wrong. Two examples we cited in Wednesday's podcast were the Fed's guesses for what was going to happen with the economy last year at this time. And as you can see, they're almost universally wrong. Furthermore, the Fed is still predicting a positive GDP year in 2022, even though the first half of the year was sharply negative and Q3 looks like it's going to be flat at best. Who believes these people? Mainstream financial media, I guess. You'd be wise to not listen to them and make your own decisions. All part of what we discussed Wednesday, the 21st. 1 year ago today, they were forecasting GDP for 2022 to be between 3.5% and 4.5%. Okay. They're expecting an unemployment rate. Okay, well, I guess they got that right. They're expecting PCE inflation to be 2 to 2.5. What's it now? 5? 5.5? The PCE? Core PCE, 2 to not even half of what it is. They expected the Fed funds rate by this time this year to be at 0.1 to 0.4. And their Fed funds guess for next year was 0.4 to 1.1. Again, as of today, it's 3 to 3.25. And they've told you that by the end of the year, it's going to be 4.25 to 4.5. They're not even freaking close. They're not even remotely close. I mean, we could have just had a monkey throwing darts at a board with numbers on it and done better than the Fed. Oh, but they're just going to keep hiking because they got it straight. So what did they say today? Look at this little screenshot from what Zero Hedge put out on Twitter. As they said, Fed can't even achieve its own goal of pushing the economy into recession. They see currently, on the current table, GDP for 2022 to be plus 0.2%. That's what they said today. Okay, let's do some math. As I note on my tweet that went with it. Q1, negative 1.6. Q2, negative 0.9. Q3 looks flat at best. So to counter all that, and to finish up the year at plus 0.2, Q4 is going to have to come in at 3%. There's no way in hell Q4 is coming in at 3%. So how the hell do they back into that number? You tell me. They just putting out whatever, just spin and mope. Numbers don't matter. They lie. We know they lie. They know we know they lie, and no one cares. Try to talk it into existence. You can explain it better than I. This is remarkable. Like we said earlier, it's not just gold and silver all the time at TF Metals Report. We got to keep an eye on copper and the base metals as well. A lot of interesting things going on in copper. London LME inventories are sinking like a stone. Copper used as collateral, probably overused as collateral in China. We're starting to look like maybe there's a copper shortage. Bloomberg even wrote about it on Thursday the 22nd. So that was something we discussed that day at TF Metals Report too. And then finally, copper. Again, this is something we keep checking in on. It too, remember, got above its 50-day, fell back, bounced, got above its 50-day, fell back, tapped its 50-day even today. You can plainly see the levels here. 340 as support. The 50-day moving average is resistance, but then also 370 as resistance as well. Get above 370, this whole notion of a short squeeze and all that kind of stuff in copper, yeah, maybe. For now, though, I mean, clearly it needs to stay above 340 or it risks coming down to 320 and trying to hold, that low from earlier in July. So watch copper tomorrow too. See what it does. As you know, we've spent the entire month of September on Crash Watch after the warnings given to everyone by Jerry Powell at Jackson Hole back at the end of August. We're about ready to upgrade that to a warning after the action on Friday. Currency markets going crazy, bond market melting down, real rates spiking. And the only thing that saved the S&P 500 from the lowest weekly close of the year was a last hour ramp job where the index rallied a point a minute for about 45 minutes. Still very, very near its lows of the year. And next week brings the end of the quarter and all of the volatility that usually comes with that. Gold and silver had a lousy close as well, but anytime the equity markets are melting down, you get general liquidations as anything that's got a bid gets sold for margin calls. And who knows what next week will bring. So hopefully we will keep it all together on this end. You keep it together on your end. And then come back next Friday for another edition of the TF Metals Report podcast highlights. And we'll see what next week brings. Thanks for listening, everyone.